Welcome to the DBS analyst briefing. You've heard the media briefing, so we can go straight to Q&A. So I think the first question we can start with is Yong Hong from Citi. Yong Hong, please go ahead and ask your question. Yong Hong?
Can you hear me?
Yep.
Yep, thanks. I will just keep to three questions. Firstly, on dividends. So based on the earnings prospects so far, could you remind us on the thinking behind raising your dividends by 24 cents higher per year and your capital return equivalent of 60 cents annually across 3 years? Just wanting to get a sense on how confident you are to sustaining this, and any update from the MAS on the potential lifting of your penalty on capital in terms of what is asked and what you have delivered. And second questions on loans. Are you seeing a little bit more opportunities to capture enterprise spending or corporates catching up on IT chip investment across the regions? And should this be reflected through your volumes growth for the rest of this year? And finally, on your digital assets slide, could you give us some color on how these flows through your P&L? And also, is this digital asset offering something that is well sought out by your wealth clients? Yeah, these are all my questions.
Yeah, thank you. So your first question was around dividends. We will answer that. The second question was around enterprise spend.
No,
loans. Oh, the growth in loans. Sorry, I was fiddling with stuff. And the third question was around the digital, the income growth around the digital asset ecosystem, right? Okay, you want to do the dividend one, and I'll do the loans one.
So hi, Yong Hong. This is Hui. So I think we communicated this quarter. We said there was our CAR ratio came down by 0.4%. Half of that was just the capital return and share buyback. So consistent with that communication, you'll continue to see that we are committed to the capital return dividend as well as the share buyback over a 3-year period, right? So that you can take as something that we have committed to, unless something that's really unforeseen. And then on the step up, I think the board will review every every quarter. At the end of each year. That's when we normally do it Q4 to see whether we will lift it by about 6 cents, and that gives you a 24 cents lift. I think when we look at the trajectory, we should be able to still commit to this year and probably next year.
Yeah, so looking at the 8 billion of stock, right, which we had declared before, 3 billion was for 5 buybacks and 5 billion was the capital return. So as you know, we have 3 levels of dividend. One was the core dividend, one's the capital return, and one's the share buyback. And in terms of the share buyback, we've done about 12%. In terms of the capital return, we've committed to the 60 cents for 3 years. That's because it's part of the stock. It's fine. The flow, as long as we are stable on our income, around 11 billion or so, we can still pay around 60+% of that. So that should be, it should be fine. I think, depending on where rates land, but I think we can still afford to continue to keep the pace. The second question was loan growth in the region. Loan growth in the region. Oh, okay. Forward looking. Okay, so I think what we are seeing is sort of muted growth in Hong Kong and China, but better growth elsewhere. So Singapore is still, for large corporates, still strong. As I said, the government land sales program has been pretty active. There's still quite a lot of deals to be done there. There are still, TMT data center deals in the pipeline, all quite pretty chunky and pretty solid, with hyperscaler off-takers, etc. So that's pretty strong. The renewables, especially in the renewable infrastructure as well, is strong. Cables and connectivity infrastructure spend is strong. As you know, we brought a PF project finance. We built a very solid project finance team several years back. So they have been leading a lot of the more complicated deals where we structure, we originate, we set up PPPs and off-takers, and we have ECA coverage around that. And we're leading a lot of these deals now in the region. And so that's, again, it's a long-term pipeline, but it's something that we've built over the long term. So in short, we should see continued sort of slow and steady non-trade growth in the IBG business from TNT, real estate, renewables, and upstream metals and mining, etc. And that should mitigate some of the downdraft in Hong Kong and China. Oh, then the third question was around digital assets. And I think if you look in our annual report, you will see that we said we made 13 million in digital assets last year. This year, we're running at more than 3 times that. So, depends on where the regulations go in the region and how many players come in. But I'm optimistic that we have and had a head start. My team are all over this. They're talking to all the major players. We're all over the new regulations. And our strategy is to be in infrastructure player, but also an exchange. So as you heard me say, we want to originate, issue, list, trade, custodize, do the payments and settlements, bank the ecosystem, manage the collateral, manage the reserves. And it's a holistic coverage. It's not just, oh, I want to do one thing. It's not just, oh, I want to do stable coins, so I want to do trading, or I want to do listing. It's really the whole suite. And so far, very profitable actually. It's a good business.
Thanks.
Thanks for this. Sorry. Can I just follow up on my first questions? Any update from the MAS on the lifting of your penalty in terms of what was asked of you and what has been delivered?
Oh, you mean the up-risk charge, is it? The multiplier that they applied on the up-risk charge. So they have not communicated so far on when that will be lifted.
And that's 70 basis point of the RWA, right?
It's about 0.4% of CET1.
Okay. Thank you so much. These are all my questions. Thank you.
Okay.
Next question from Jayden from Macquarie. Jayden, can you hear?
I was just wondering if you could sort of talk us through the drivers. Is that more point in time because of some hedging, or has something sort of structurally changed, with how...
You came in halfway through. Could you repeat the question from the start?
Okay, sorry about that. I just wanted to understand better the non-SGD, rate sensitivity. I think during the media briefing, Su Shan mentioned that, the sensitivity to a fall in US dollar rates would actually be positive. I just wanted to understand, is that because of some point in time hedging, or has something changed? What would be the drivers of that? Because that seems to be a bit of a difference with the past. Thank you.
So Susanna?
Yeah. Okay. Well, there is, it's a snapshot of our balance sheet at that point in time. But we have a net total liability of about 40 odd billion in other currencies, primarily US dollars, that is floating. So for us, as long as rates go down, which it hasn't in the US dollar space, that will give us some savings.
It's largely in the T&M book. So the GFM book is basically funded on a short-term basis. And that's the bulk of the 40 billion that we are talking about.
Yeah. And obviously, we hope to continue to grow that liability. It's it's been a war cry for us to keep growing our deposits, and whether it's Sing or US dollars, that's a big focus for the team. So then it depends on how much we grow that book by.
Okay, thank you. Just to understand the 40 billion liability, that's floating, how fast could that sort of swing, back to an asset? And then another question I had just on the Singapore dollar rates. I think you mentioned that it makes sense to look at them, in separate buckets, right? Given the whole flow through has broken down. But what's your assumption on SORA, between now and year end when you think about the guidance to us? Thank you.
Do you want to take the US dollar one?
Okay, Jayden, this is Phil Fernandez. I'm the corporate treasurer. So to pick up on your questions, let me take the US dollar one first. That particular sensitivity essentially has two parts. One is, Sok Hui said, within the markets business, we have a sensitivity. We've also put on some central hedges. So those have a duration of about 3 years average, although there is a distribution around that. So I would say it's pretty much structural if you're looking out over a 3-year horizon. So that's point number one. And your second question was SORA. Okay, well, SORA has really gone down a lot relative. The US has not moved, and Singapore dollar rates have gone down a lot. We're looking at rates staying at around the current levels, around the 1.7 handle or so, given that a lot of the softness in the rates has really sort of pre-cut the Fed, if I could put it that way. So those are assumptions behind the NI guidance that Su Shan mentioned earlier.
But as I said, Jayden, the SORA is very, very volatile because a lot of it's driven by the FX. And increasingly also, I think we talk to clients who borrow in Sing dollar, and I think more and more, I think people want to lock in a rate because they can't deal with the volatility now. So like in a mortgage book, more of our new clients will say, I think I'll just do a 2-year fix, for example. And I think I won't be surprised in SME we start to see that trend as well. But they're already doing it through IRSs, right? So because SORA is a lagging indicator of what banks post the night before, and it really is hugely volatile. So it's very hard to predict, to be honest. So I would say then have a view on the exchange rate. I think better we do that, and have a view on the forward rates, and then that could be more instructive on where you think SORA can be on average.
Yeah, thanks for your thoughts. I was just thinking that if the Sing dollar continued to strengthen, that may put some more downward pressure on it. But thanks a lot for talking through the assumptions and the sensitivity.
But I guess
really
if the Sing strengthens and it strengthens too quickly, and you're the monetary authority, you might do. It depends on what the MAS does, right? Do they drain? Do they sterilize? Whatever. So do they change policy? But it also depends on our trade numbers and how we are in terms of our competitiveness versus our peers in the region. So you're right. I mean, if the region currencies go up as a block and our SG near is affected, then you will see some corrective action. But generally, it's a double-edged sword, right? You're right. If the Sing dollar strengthens, then Sing rates will be affected adversely. But if the Sing strengthens, you will also see more flows into Sing. And we are the biggest bank here, so we tend to get more than our fair share of the outsized flow into Sing, which we can then deploy, especially if it's cheap. So it's, as I said in my call earlier, it's like whatever happens to the Sing rates, you just have to mitigate. You can't be a sitting duck, right? So, and then when it's volatile, Phil and the team, Andrew and the team, they will just note whatever they can from the volatility and try and protect our balance sheet. So build that fortress balance sheet. But as the business, we look at low rates and we go, okay, go on and grab market share, right? Grab market share on deposits, grab market share on wealth, whatever it is, grab market share on dollars, grab market share on AUM. Mitigate those FX or rate volatility with volume. Does that make sense?
Okay, great. Thank you so much. I really appreciate it.
Thanks, Jayden. Next question from Nick Lord from Morgan Stanley.
Couple of questions from me. First is just on the assets under management, on the wealth management business. Can you give us any disclosure on net new money in the quarter? And just any sort of commentary you have about sort of investor appetite. Maybe your competitors are saying that Q3s remain very strong, so just any comments on that. And then just on going back on to your comment on the interest rate sensitivity. Just in terms of the hedge, have you been able to put on more this quarter, or are we seeing that run down, obviously, as we see hedges roll off? And I guess because we've had an inverted yield curve, you may not have the same opportunity to lock in the last 6 months.
Okay. So on net new money, as I think we said the figures just now, right? The net new money for PBTPC was up 9 billion, which was outsized. Normally it's 5 to 6, so we had a very good Q2. Treasures was up about 2, so total was up about, for wealth was up about 11 to 12, or treasures up about 3, so total for wealth was up about 12 billion. And I also said that, you know, with Sukun and his team, we're really focusing across the wealth continuum. So it's a high end, but it's also the mid end, it's also the low end, right? Because there is a structural growth in wealth needs in Asia. And I think the DBS brand as a safe, solid, you know, reliable and digital bank speaks well to our branding. And so there's just structural organic growth, and we'll continue to grow that. What was the other question?
The other question.
So hedge, whether you can continue to add to the hedge.
Oh, the roll-off of the hedges.
Yeah.
Yeah.
So in the first half, we were able to replace about 29 billion of maturities at a 60 to 70 basis point lift. There will be about the same magnitude of maturities coming in for second half. So I think we can roll over at broadly the kind of similar kind of
Pickup.
yields. And so we have a duration and book is about 2 to 3 years. So that will sustain us for the while that we hope rates are kept lower.
Okay, perfect. Can I just ask one more question, actually, while I got it? Just on the crypto, the digital asset side, and obviously we're reading lots of stuff about this at the moment, and one of the comments that keeps on coming up is that it can be used as a cheap way to make payments, and especially international payments. And I just wondered if you agreed with that, because obviously the source of a lot of those comments is crypto companies. So as a bank, would you agree with that, or do you think that the existing way you make international payments is cheaper?
Okay, so I will start, and then Soon Chong, our head of business, can chime in. So, you know, at least for Asia, our real-time payment rails actually work, right? So, like, you know, in Singapore, fast works, Hong Kong faster works, India UPI works, China we all know how good the day-to-day 24/7 payments, local domestic rails are actually working quite well. Then you have the cross-border payments, which, you know, we have a product called GlobeSend, which maybe we haven't marketed to the analysts enough, but we will. And that's our answer to Wise or Revolut or Monzo, right? Which is, again, harnessing what domestic payment rails are. It's cross-border using the current payment rails, but because it's domestic 24/7, you can also effect that very efficiently through ledger transfers and using our cross-border and domestic rails. So, is there a huge use case for tokenization on private chain to work? There is, if you have a lot of people that you need to settle with 24/7, or a lot of merchants, or a lot of payments and settlements, millions, if you will. Yes. But if you just want to do the odd transfer, then no, the current rails work. Right? I mean, Soon Chong, you want to chime in? I've got GTS head here.
So Nick, thanks for the question. So I think that there are many ways of delivering international payment, and we have a lot of products and services One of which is what Sushant mentioned about. For low value cross-border, we have GlobeSend and a lot of other ways of delivering payments that are cheap, available 24/7, cost effective, and deliver the goods for all our clients. In international payments, I think you're referring to correspondent banking and whether stablecoins might be a replacement for that. I think that for most contexts, large value, trust, security, international payments today work. There might be certain contexts today whereby the payment delivery mechanisms don't fully do the work, and as we talk about whether stablecoin could be a use for that. I think there are a lot of pieces and parts. A lot of it will be regulations, whether there's going to be adoption, how the compliance is going to work, so on and so forth. We're closely monitoring the space to look at the context whereby international payments can be improved, and we're able to capture a good share of the economics from those activities.
But Nick, I think where it could serve a purpose is if you live in a country where you don't have a stable currency. So if you live in Latin America or Africa and you want to buy goods from JD or Alibaba or Ant, whatever, and then, having a stable coin to pay for your supplies from Asia would be helpful, right? But you then need to on-ramp and off-ramp it. You need, you need to send money to with US DC or whatever into Hong Kong dollar stable coin, which then goes off-ramp into RMB, right? So there is a use case there which we want to work in as well. So there are opportunities kind of tying maybe more the emerging market trade related flows where they don't have a stable currency themselves. But I can't see governments kind of rushing to facilitate that because, that flies in the face of monetary policy management for these countries, right? So as Sun Chong said, we have to monitor the regulations. We're a regulated bank. We'll play where we're allowed to play. But we see opportunities in the infrastructure and being a trusted partner for the big players, the sanitized players, if you will. We see also opportunity in the overlay stuff, right? Whether we talked about the structured notes or, OTC derivatives or custody or listing or whatever it is, on-ramp, off-ramp. We see a lot of opportunities in that, and that is very scalable. That business is very scalable. So that's something my team and I want to continue to grow in line with the regulations.
Perfect. I think that's very interesting, useful. Thank you very much.
Thanks, Nick. Next question from Harsh from JP Morgan.
Hi, Harsh.
Yep.
Okay, great. Thanks. So a couple of questions. First is, I just wanted to understand the payout slightly better. I understand volume over margins, but volumes comes with RWA growth. And right now, at least till 2027, we are paying out 75%, right? About $4 of EPS, around $3 of payout. So if we end up getting RWA growth, plus there's buyback on top of it, the question is, how much are we comfortable with two things? The 60 becoming 66, does it only go up the regular dividend in 4Q25 or 4Q26 also is a given now with such a big rate move? And then second, how do we think about the actual minimum CET1 that we would get to organically, let's say over the next 2 years?
So he's asking about the dividend. So you're asking about the ability to step up the dividend in the fourth quarter, right?
Yeah, 4Q this year. So two questions, 4Q this year and next year, because if I remember correctly, last quarter, at least my read of your or Sok Hui's comments was that 6 cents increase in December 25 will happen and even FY26 will happen. And then what is the CET1 if we end up getting faster RWA growth over, let's say, next 2 years?
Oh, yeah. The RWA growth we factored in would eat up about.
Harsh, can I try to understand your question? So I think you're talking about the step up, right? And I think if we do some simulation, we are okay with stepping up 6 cents end of this year. I think based on some simulation, we should be comfortable stepping up 6 cents in 2026. But it's harder to call if we look further out because there are just too many moving parts, right? So we have to see how much of the RWA growth will be needed and what kind of payout ratio it will imply from our organic growth in earnings.
Yeah. But I think your question on RWA step-ups, I think, yes, that will happen as our, loan growth goes up alongside deposit growth. But it's important to also realize that our deposit growth delta is much higher now. And a lot of that spare deposits being deployed into MAS bills and HQLA, which is no RWA. So it's actually ROE accretive and doesn't absorb RWA. So, and it gives us more earnings, right? So that's the other prism to take. But yeah, granted, I mean, if Sing dollar rates collapse, then that is going to be a big headwind. If there's war, that will also be a big headwind, right? So we'll have to see, at that time in place. But I think to Sok Hui's point, 2025, 2026 are probably okay. We simulated with flat earnings between now and then that we can probably pay that 6 cents step up this year and next year.
Right. So on a fully phased in, we are at 15.1 and minimum where we would be comfortable with, let's say 2 years out is 14. Let's say if it starts hitting early 14s, is it still okay to keep that payout going?
Yeah, 14.3 is still above our management operating range guidance of between 12.5% to 13.5%.
Okay, great. Thanks. The second question is on the private banking flows. So two questions. One, are you seeing more flows in Singapore dollar versus, let's say, US dollar? Has there been any shift with dollar weakening? And second, what proportion of your portfolio is now discretionary management? And how has that changed over, let's say, last 3 to 4 years?
So the inflows of deposits, right? Yeah, so for Sing dollar, the year-to-date system grew by 47 billion, and we kept our share of that. So we were up year-to-date 20 billion in Sing dollars. Foreign currency, year-to-date, year-to-date system was plus 51 billion, and we grew by
8 billion.
8 billion.
Right. So you're getting a bigger share of Sing dollar, which should be, but are your clients shifting from USD to Sing D was the question effectively.
You're seeing, on the margin, some shift, certainly, but, the Sing itself for international investors is not, other than, you buy the SGX, ETF or whatever, it's still not a natural, liquid currency yet.
Okay.
But for some of the PB clients, yes, you are seeing a shift, a reduction in the US dollar overweights. You are.
Makes sense. Thanks. And sorry, on the discretionary portfolio, what proportion of your AUM is there and how is that changing?
Discretionary portfolio.
Yes. So the PB side discretionary portfolio, we've seen quite a strong growth as well. So now we've crossed $11 billion already of our AUM.
Okay, so still small. Okay, thanks. And
Wait, no, but that's just our own managed. But if you take all the third-party funds and all, that'll be much more.
Oh, of course, of course.
Yeah.
So if you're talking about discretionary as in our own, yes, then that's 11. If it's third-party fund, that's actually been growing quite robust. Yeah.
right. Maybe I'll reach offline for that. And the one technical question, exit NIM, what is it?
Oh,
For-
for June or July?
Give me both.
Yes, you want both. I knew you were gonna say that. So it was 195 for June and 198 for June and 195 for July.
All right. Thanks. And final question on digital assets. One of the biggest one, do you have deposits on public blockchain or not yet? Or is it still on private permission blockchains?
Private permission blockchain.
Okay. Has MAS regulation evolved where you can?
Oh, we did one ages ago on the Polygon chain.
Oh, yeah, but that was an experiment, right?
Project Orchid, yeah.
Yeah, okay. But have you gone commercial or are you looking to go commercial with a public blockchain tokenized deposit?
Depends on regulations, Harsh. It's hard to say. Never say never. But as I said, I don't, a lot of regulators are still, still want to control their monetary policy, right? So right now, a lot of the flows are still on permissioned blockchain. It's the bank to client closed loop system.
Yeah. No, the reason I'm asking that is exactly that, because Singapore is pro blockchain but not pro crypto.
Correct.
And the biggest institutional users of on-off ramp are the large crypto players, like someone
Correct.
offering crypto ETF and all of that.
Yeah.
And if the regulation is not there, then while you have one of the best in class capability, you are kind of limited to high net worth or very small group of players. So Hong Kong is moving ahead, US has moved ahead. Is there a risk that Singapore kind of gets left out, or is there some kind of way to be relevant in the DLT world without exposing retail guys to crypto? And what are your conversations with MAS? Because Singapore seems to be kind of getting behind on that.
Yeah, it's a very, very timely and very good question, and we've been, engaging them constantly and daily. Certainly when Hong Kong MA came out with their ordinance, that I suspect that may have also put some pressure on us. But we play in both markets, right? We're both in Singapore and Hong Kong. We're also actively looking at ADGM. So and other than high net worth, we also provide services to the crypto natives and the market makers and the institutional players. So I think MAS is okay if we do B2B. They're just not okay if we do B2C, or to be specific, they're not okay if we do B to retail C. They're okay if we do B to accredited investors, as a block.
B2B2C.
So, yeah. So, and the irony is, the B2B is also B2B2C ultimately. But as long as we're not in that B2C chain, I think they're okay. So the B2B flows are growing, actually. They are growing. And I see opportunities for us to continue to grow that. Whether Singapore or Hong Kong or potentially Abu Dhabi, we'll see. It's all harsh. It's moving very quickly now, but as I said, we've developing the muscle to play in the whole chain, and we've got to figure out what's the low hanging fruit that we can build on. We've built already, as you know, we've done, because we've done so well this year. I said to the team, hey guys, let's not waste our head start. Let's continue to build on what we can be good at, right? And I don't want to do this too quickly and then fall foul of the law and not do this correctly. So I'd rather do this slowly but surely and be that trusted, banking partner, because you're going to see, the volatility, and you're going to see some bad players emerge again. We want to make sure we don't fall into that trap. But I do think there will be rising demand for a good player to play in the infrastructure, and I want that good player to be us. So we have the ambition and we have the ability, and we just have to continue to execute.
Got it. Thanks a lot.
Thanks, Harsh.
Harsh, can I just add one thing? You asked about exit NIM in June and July. I will say that, frankly, you should expect actually some slight decline, some marginal decline, partly because we are bringing in so much deposits. And the deposits that we are bringing in actually gives us additional net interest income. We deploy them at a margin of more than 1%. And actually, it's quite good business. So the key here is that we are focused on NII growth. But whatever we bring in can be decretive to NIM and be decretive in some sense, which doesn't worry us. You know what I mean? So we are focused on bringing more deposits. The deposits come in, they don't earn the 2% margin that we have, say, in the second quarter. But it's something that we are focused on doing.
Thanks, Sok Hui. The next question is from Melissa from Goldman.
Just on this, AUM and deposit growth that you're having, just a little bit, we want to just understand a bit, like the numbers are pretty high, as you mentioned, versus your peers. Just wanted to, is it more market share gains? Is it just that, the amount coming into Singapore, it's very large, and that's why we're seeing the SORA fall as well? Or is it a large part of it's coming from your Taiwan business that you're doing very well in? Can we get just a bit of color of this high growth?
Melissa, it's not just Singapore, it's Hong Kong, it's China, it's actually across the board. Chinese flows into Hong Kong have been remarkably strong. And our team in Hong Kong has done a really good job, both in the priority and private bank, to get more than their fair share. Singapore continues to be, to grow, but the flows are also, very international and very mixed. Then we also have the flow back from people who don't want to buy SGS or treasury bills, right? And that requires a lot of work, but we do a hell of a lot of AI, machine learning and modeling to make sure that when every one of these bills mature, we're there to nudge them to bring their money back to us, right? So that's all the work that we need to do to keep our deposit share growing. Is it structural? I do think it's structural. I do think, families are realizing that they need to plan, they need to structure, they need to they need to do more. And so our team has just focused on make sure you're in the estate planning. So your first conversation has to be, have you thought about the future? Have you planned? And once you structure, so you go in, you do the wealth planning, you do the insurance for the children, their grandchildren. You do a trust structure if you need to. For the lower end, you don't need to. Then once you're in and you can finance the ULI or whatever, you're in. It's very, very sticky. Then after that, the wealth fees will start to come in. And I was looking, because Harsh also asked the question, Tse Koon might have the answers on the AUM, but I was looking at how much more we're making now on discretionary, which is third-party funds and in-house discretionary. The first half of last year, we made 200 million. This first half, we're making 230 million on that. So I think it's growing by some 15% or so, year on year. And the percentage of recurring income is about 15% as well. So, but bank assurance is growing even more. Bank assurance is growing by very high double-digit growth. That's also very long-term and sticky. So it's all down to the strategy and execution. If you can bring in the new clients, first it comes in as net new money, then you structure it into estate planning, trust, and insurance. Then you layer in the funds, third-party funds, in-house funds. You overlay with FX, interest rates, and structures, and equities or bonds, whatever they want to do. Then you have a solid wealth offering. And the key is to keep the continuum. You don't just focus on the top end. You focus at the retails. Focus before they get rich. Then as they get richer, they do more with you. And they don't have to change the RM. They don't have to change the UX. It's all in the same wealth app, right? So that's key.
Right. Just in terms of it, so would you say like more than half of the new AUM this quarter came from Hong Kong? And also between Hong Kong and Singapore, in terms of the AUM deployed, is Hong Kong more like than put into deployment in terms of the mix versus in Singapore? Or would you say they're roughly equal?
No, actually, our AUM growth, I would say, has been very broad-based, right? So we have got 2 booking centers in Singapore and in Hong Kong. Hong Kong is primarily really booking for North Asia, which includes customers from Hong Kong, Taiwan, China, right? A lot of these clients, because of their own business interests, etc., have also a whole bunch of offshore wealth that's been created. And so that's kind of where we get a lot of the net new money, as well as the investments that AUM growth from. Singapore is definitely bigger because Singapore is a center not just for North Asia, but also for Southeast Asia, for Middle East, North Africa, South Asia, as well as for Europe, right? So because of that, Singapore is bigger.
Yeah, Melissa, I think to just follow on what Tse Koon said, the world is getting very fragmented and bifurcated, and people are looking for backup plans or insurance policies, right? So the UK, after the resident non-dom laws came out, there was an exodus of funds. Some of it went to Dubai. Some came to Singapore. Similarly, if the Swiss inheritance tax laws are passed, then you might see an exodus as well from Switzerland. So there's a lot of money moving around financial centers right now. And I do think that structurally Singapore can play to win. And structurally DBS can play to win. But we need to continue to invest, and that's what the team is doing. Tse Koon and the team are continuing to invest in, getting good people to bring in this new growth paths. But I think the way we're doing it, right, start with domestic, start with the wealth continuum, and then build strong wealth centers in all our core markets. So China, we have a strong wealth center. Hong Kong, we have one big wealth center. We're building another one, and the number of walk-in customers from China is just amazing. So I think, having that, and then Singapore, of course, our headquarters also strong, and then looking at other growth corridors as well. That's the plan.
I think if I may just add, if what you are asking as well, it's not just about net new money, but AUM growth. Of course, certainly, in this kind of first half of the year, we did see a rebound of the market in Hong Kong, right? So a lot of the Chinese stocks in Hong Kong, we've seen a rebound. And on the back of that, indeed, we have seen customers actually deploying a fair amount of that. So the good thing is that today we are seeing both a resilient kind of play between that market as well as the US market. So because of the rebound, yes, indeed, we have seen an AUM growth on that front. But the AUM growth is not necessarily just booked in Hong Kong, because likewise, we would have clients who are booked in Singapore with AUM holdings on those Hong Kong-based securities, right?
Right. Thank you. I think the next question on asset quality. It has been a very good run so far on asset quality, despite what's happening in the world. I just wanted to get a sense from you, is there anywhere we should be worried on, what we should be aware of, or do you think, we are on a good path for the next year and a half?
Melissa, I don't want to be complacent, so we continue to stress test like mad. Anything coming new, not new, we just stress test it. We've been very, very conservative, maybe too much so. So especially in China and Hong Kong, being very conservative on real estate there, very conservative in Hong Kong, very conservative in SME, very conservative in consumer unsecured loans. So we've been very conservative. A lot of our asset growth is really in the large corporates, in MNC, in technology, software companies, data centers, renewables. So big players, SOEs, etc. So I think we found a way to be more predictive and preemptive in our credit assessment. So building models that have sort of line of sight on predictive cash flow. We're very cash flow based as a bank. We're less asset based. I mean, a lot of our LTVs might be already quite low, say less than 60% of its property, but we're very cash flow based, right? So my first return is always going to be the operating cash of the business. It's not going to be having to sell your asset to pay me back. And that's been the rigor and discipline that we've put in for the last 5 years. And that seems to be working out, especially through COVID and through all these tariff issues. But I also have to make sure that we're not too overtly conservative, right? So the SME guys are working on tight algorithms around program lending, etc., which we're going to see. So far, for example, in India, when we did some of these program lending, it's worked really well because India, with SME, we have the operating account. We see who they pay. We see how they receive payments. And so we are very on the ball on what the cash flows are for SME. So that's good. And then, as I said, with the large corporates, I'm comfortable that we've deepened our relationship with the key big players in the region. So these are all large corporates, and they have multiple cash flows. So I hope we are not being too conservative. Is the honest feedback? But I'm comfortable with the stress test, Melissa. I don't think we've missed anything. And if we did, our GP reserve of 2.6 billion should be more than sufficient. The overlay, the GP overlay should be more than sufficient. If we miss anything, touch wood. But I don't think we have. It's my honest answer.
Good. That's good to hear. Then just lastly, just very quickly on the hedges, you said that it's 3-year duration. So when the Fed kicks in, as you said, you get an advantage. So let's say if we go into next year, there's still expectations of a few more Fed cuts. But post that, then when the hedges do roll off, does it mean that for next year we won't see anything, and then the year after, then we'll start seeing some of the NIM pressures come back in as the hedges roll off? Is that correct way of thinking?
So Melissa, this is Phil again. So the hedges are quite spread out, right? So we have them over a range of tenors. When we quoted 3 years, that's the average tenor of the US dollar hedges, right? So you should think about it as a certain amount rolling over each year. And the rate at which we replenish depends on a few things. Because what you quoted was actually the short rate, the policy rate. But remember, there's also a term structure in, say, the government curve. So if that term structure reasserts, then you can still get a pickup on redeployment. So it all really depends on what the term structure looks like in 2026, 2027. And, everyone in the street will have their own view on what the shape of the curve is going to be. So I hope that gives you some color as to how we do our hedging.
Right. Thank you. Just to confirm, you have US hedges, US dollar hedges. Do you have Sing dollar hedges and Hong Kong dollar hedges, or mainly just US dollar hedges?
US dollar and Sing dollar hedges.
Okay. Thank you.
Thanks, Melissa. We only have time for the last question from Akash.
This is Akash from UBS. I'll keep it quick. I just have 3 questions. So the first one is, the guidance on the NIM net floating assets was very clear, 90 billion of Sing dollar floating assets and how the maths work around it. But based on your simulations, as the hedges roll off, what is this 90 billion going to look like, let's say, June end of next year or December end of next year? How does that number change is my first question.
I would say, Akash, that our corporate treasury division is actually very nimble. I think we take a view of rates, and then we sort of are flexible with whether we want to do more fixed or more floating. So not really anchored on, we must roll off and therefore we must take fixed. So I think it's a read on the external environment. And what we have proven is that we actually do make good calls, and we are sharing with you the sensitivity so that you can do your own simulation at this point in time.
We know exactly how much matures when, and sometimes these hedges were done earlier when rates were actually lower. So when we re-hedge them, actually you have a yield pickup, some were not. So there is a different time and different rates. So it's quite hard for us to answer it in, definitively, to be honest. But I would say based on our experience so far and based on our ability to be nimble and ability to kind of catch, market sensitivity, I think we've been okay.
Right. I think the reason I'm asking this question is because my understanding was that hedges only delay the NIM transmission. They don't structurally change the NIM transmission that you're going to see. And at this point, obviously, DBS is seeing less NIM compression versus peers because of the hedges. But at some point, this will change, right? Is that not the right way to think about it?
Maybe if I can step in, Akash, this is Phil, right? So remember that, when you think about NIM, that is really a function of the install base. And as we deploy surplus deposits, and a big chunk of that's going into HQLA, as Sophie mentioned earlier, we're getting margins above 1% on those deposits. So it's going to blend down the NIM. And that's why, NIM doesn't pay dividends, right? NI pays dividends. So we are focused very much on NI growth. And the NIM may come up, but the ROE will go high because you're taking deposits, making a margin of 1% in terms of deployment. And the risk weights on that, and this goes back a little bit to the earlier question on CET1, you will not see such a downdraft on RWA because that's what Su Shan said, we're putting it into HQLA. So I hope that gives you some color on how we think about it.
Understood. Thank you. The second one is just on Hong Kong CRE. So as you might have seen, some of the Hong Kong banks started booking more provisions for their CRE exposures. Just wanted to check, how has your thinking evolved on it? If you could specifically comment on New World, which you have talked about in the past, and if you could talk about the provision coverage that you have on the Hong Kong CRE book, commercial CRE.
So the Hong Kong CRE book is about 17 billion exposure, 12 billion in mixed use, 3 billion in office, and 2 billion in retail. And it's mostly in the large names, the large top tier blue chip names. And the LTV is in 60%. A lot of what we've seen in terms of the pain has come from the mid-cap and SME sector. And as you know, we had some provisions for that in the last year or so. But we managed to, actually all those that we had NPAs, we managed to sell and we managed to recover. So there is liquidity in the market. It's just that the prices have to be realistic. Having said that, though, I think when I look at the names of our current exposure, I'm quite comfortable. All these guys, got strong cash flows. They're all conglomerates, big names and blue chips, and they're all hunkering down. But I think they're going to be all right.
Does that also mean that you don't have actually made any provisions for this book, the blue chip names at this point?
So you're not coming across very clearly. Are you asking whether for the real estate sectors in China and Hong Kong, do we set aside sort of additional general provisions?
Yes. Do you have provisions?
Yes. So it's part of the overlay that we set aside as well.
Okay, understood. And then just the last question is on the sudden pickup in the net new money that you saw. Again, trying to understand what caused this shift from 4, 5, 6 billion to 9 billion, And I think what you're suggesting is this can actually sustain at this level because there are structural drivers behind it.
Sorry, saying that net new money?
The 9 billion net new money.
Yeah.
It was 9 billion this quarter, as opposed to 5 to 6 we normally get.
Correct.
Is it sustainable, or was it like, a spike?
Oh, okay. Okay, so I do think that it should be sustainable. I look at it more from an annual basis, right, rather than a quarterly basis, to be fair, because there are times when the movement of funds will be affected by various kinds of activities from the underlying clients, because sometimes they have a monetization event in their businesses, etc. So if I look at it on an annual basis, I think the kind of numbers we've seen on an annual basis should be something that's sustainable.
So as a reminder, Akash, we've done about 20 billion on an annual basis for the last few years. There can be volatility quarter to quarter, but Sukun's referencing the annual run rate.
Correct. So we're looking like a 20 billion-ish kind of a number annually. I think that is something sustainable.
Okay, understood. Great. That's all my questions. Thank you very much.
Thanks, Akash. Okay, that's about all the time we have. Thanks everyone for dialing in. We'll see you next quarter.